at their leisure. All right. Well, hey guys, I'm Will Roberts. I'm the partner of military lending at UMortgage. You're going to learn a lot of stuff today about real estate. I've made some interesting moves in real estate. I'm not like a real estate guru, but what I can tell you is that location is definitely supreme. So my wife and I live in New York now. This is my son getting a pump at the Equinox. This is us in Central Park. It's great. This was my daily life in Philadelphia when I was getting my MBA. And I can tell you that I know which city I'd rather live in full time. If anyone's from Philadelphia, we could talk later, but it's a very interesting spot. Some fun that you guys don't get down in Virginia. So I'm originally from New Orleans. I went to the Naval Academy Prep School. Naval Academy, I was a Marine for 6 years. I got out. I started a tech company called Paintrue with a couple of buddies, also Marines, also Naval Academy grads. Realized that we didn't know anything about the business world. So I went to Wharton, got my MBA, was dead set on being an investment banker in New York City. Went to Allen and Company, was there for about a year and a half, and then left. Realized that I kind of wanted to be more real estate focused and started Robertson Company and Veterans Alliance. And what is Veterans Alliance? We are 13 vets. We are home loan lenders. We specialize in the VA loan. In the previous 12 months, we've done 500 VA loans, and we were the #1 loan brokerage in 2022 and 2023. We all started it because we were tired of what we were seeing out in the retail market with our friends getting messed over using the loan, and we decided that we could shake it up. So what this should really say is, what's the difference between us as a broker and a retail lender? So like retail lenders can give you everything from like a checking account to a savings account. I don't really do that stuff. I only do home loans. So what that gives is like, we are experts specifically in the VA loan. 97% of our business is the VA loan. But what that also gives for you is that you get a competitive rate market environment, right? So like, if I'm lending you money as a retail lender, I'm going to get you the highest rate that I possibly can to put money in my pocket. I don't get compensated in that way. The way that I'm compensated is, so when you get a loan, you have to pay a processing fee. So like Veterans United, for instance, is $3,500. Mine is $995. So that's like how we pay like our base level employees. And then we make money on the aggregate level. So if like I do $10 million in loans and then we sell those on the open market, we make money on that side too. But the long of this is, the shorter of it rather, is like, by us being a broker, we get to kind of look at a bunch of different products and align you to where it best fits. We did this thing called a voiceover. This is really interesting. So if I was a retail lender lending you money, I could never have this conversation. I could never tell you what I'm about to tell you, which is like kind of the game, like make yourself look like this incredible borrower, tell you where to like say things and where to not say things, because at the end of the day, like I want you to win. That's how this business grows. And if I was a retail lender, I frankly wouldn't care. I would want to win, right? Like the house always wins. Remember that in gambling. These are the top things that I hear about the VA loan. So the #1 overarching one is like, oh, the VA is lending me money. The VA is not lending you money per se. The VA is guaranteeing you 25%, and that replaces your down payment. So traditional down payment on a home is like 5 to 30%. And all the VA is doing is saying, well, we're going to guarantee that 25% to the lender, and they can lend you 100% loan to value. And so it's a win for you because you don't have to bring any cash to close. And it's a win for me as the lender, because if, God forbid, a veteran was to foreclose on their property, we would be made whole by the VA. So that's what the VA does. Some other truths: you can use your VA loan more than once, and you can have more than one active VA loan at a time. I say it at the bottom, but like there's no size limit. The only time that a size limit applies to the VA loan is if you have more than one active at a time. And so like just picking a county, like let's go to Washington, DC, the max county loan limit is about 1.125 million. So you could have 10 $112,000 loans, or you could have one $4 million loan. It really doesn't make a difference to the VA, but they aren't going to let you like house hack, right? You can't have like 8 $2 million multifams, even though we'd all love that. But if you're doing it one time, there's no limit. You can buy a condo with the VA loan. That recently changed. Previous to this, like, maybe about 3 years ago, you couldn't really get a condo. Now you can get a condo. You cannot get a co-op. So like in New York City, LA, like major city, Boston, they have co-ops. Don't get a co-op. I'll talk about that later. You can get a fixer-upper. So there's something called a VA rehab loan or a VA renovation loan. So if you found a $900,000 house that needed $100,000 of work, we could lend you the full $1 million, and then you would get 900 to buy the house and 100 to do the renovation, which is cool because you get basically what amounts to like a construction loan at a VA rate. You can use the down payment or earnest money. So in some markets, probably not Virginia, where the VA loan and military service is not as favorable, right? So like the Northeast, I'm going to pick on it because I live there. People want to see like 10% down payment or earnest money as skin in the game. And like that always frustrates me because I'm like, oh, you say that the borrower doesn't have skin in the game. When he or she was in Iraq, you didn't have skin in the game, but I guess now that they want to buy a house, it's on them. Do whatever it takes to get the house. If you have to put 100% down, do it. And then at the funding table, I'll write you a check for your down payment, and I'll write the seller a check for their whole purchase amount. It makes no difference to me and no difference to the seller. So like, I'll say this a bunch, do whatever it takes to get the deal done. The other thing is that you can waive things if you need to, inspections, contingencies, timelines, stuff like that. I can close a loan as fast as 8 days, and you can go as long as 120 days. You can waive an inspection. You can waive an appraisal. The only things that you can't waive appraisal. The other things you cannot waive are an appraisal, and in some states, a termite inspection. But again, like some sellers don't necessarily want you to do an inspection. There's no VA mandated inspection. The only thing you have to do is the appraisal. And that's because, 2008, overvalued stuff gets foreclosed, financial system falls down. We don't want that to happen again. So that's why appraisal is mandatory. I already said it, no size limit on the VA loan. We'll talk more about that in a little bit. And the big takeaway from this, guys, is that this is the only home loan that's earned. So don't ever let someone that stinks at their job sway you. Let me give you an example of this. So I have a veteran borrower that I'm working with right now. I'm not saying that his agent was pushing him towards this, but it's kind of interesting. His agent was like, oh, you only have like a couple dollars left of your VA loan. You should use a conventional 5% down instead of using the VA loan. And what's interesting is that I was like, no, like, Bob, like, listen to me. I promise, like, this is a good thing for you. And why? Because it got to the end where the house actually did not appraise, and the VA went to the seller on behalf of the borrower and said, hey, your house didn't appraise. You either have to let them out of the deal or you can reduce the contract price, which no other loan in the world gives a shit if your contract price is less than your appraisal, or rather, if your contract price is more than your appraisal. But the VA, you have a great organization that actually cares about you as a vet standing behind you. So that's pretty cool. And for him, in that case, basically on paper, they looked about even, but as I just described, the VA loan really came to be a great thing there. What makes you eligible? If you served on active duty or National Guard, you're most likely eligible. And you get something called a certificate of eligibility. So the first thing that I do when we have our conversation is I pull this, because you might not be like, there's a lot of William Robertses out there, and the VA might get it wrong, right? Like, I was in the Marine Corps, the VA could think that I was in the Air Force. All that stuff takes about 20 days to correct. So we want to know about it on day one if we need to get that fixed. So this is when I did Big Dog Chesty Puller's loan in Washington, D.C. Big Dog wanted to buy a house at 8th and I. So he spent $4 million and he was charged $1 million of entitlement. So your entitlement is always 25% of your loan amount. And what that is that's what the VA is saying they guarantee to the lender. Now, let's say that this was a $400,000 purchase and $100,000 of entitlement. This veteran's basic entitlement line would still say zero. And the reason that is that's based on a $144,000 purchase. So remember in DC, I told you it's about 1.1 million county loan limit. Well, this veterans basic entitlement would still say zero. So someone that sucks at their job would say like, oh, you don't have any basic entitlement left. You can't use the VA loan. Categorically false. You can buy like probably another $600,000 house with it because you still have entitlement based on the amount of loan you have remaining. That's a long way of saying that I own a house. Can I buy another? The answer is probably yes. Even if you have $1 left of VA entitlement, you should do it. This runs you through a calculation, but basically it's pretty simple. And I'll share an Excel sheet with you later that shows you exactly how to do it, and you can plug in your specific example. If you have any questions, please don't hesitate to reach out. But the math looks a little confusing, but I promise if you go through this, it's easy. Funding fees. So the way that the VA makes this guarantee happen is they charge people up front. However, if you are a service-connected veteran or you have a Purple Heart and you're still on active duty, you don't pay a funding fee. So if you have 10% or more disability, no funding fee. If you don't have 10% or more disability, then you pay 2.15% for the first time and 3.3% for the subsequent use, which is pretty good, considering that most civilian loans will have some type of funding fee where they call it like a point or an origination fee or something like this. This is a pretty great thing. And again, this can all be retroactive as well. And if you have VA disability or a Purple Heart, no funding fee. Retroactively, what does that look like? So let's say you're in the Marine Corps and you get out on January 1. On January 2, you buy a house, and on January 3, you get your VA disability that says, oh, on January 1, you had 10% because you fell out of your bed at the Naval Academy. Cool. Because that predates that home purchase, you are refunded that 2.15%. So it's a pretty great thing. And if you haven't done your VA disability, this is a plug for you. Do your damn VA disability. The 4 pillars of a mortgage. So credit, assets, income and employment, and property evaluation and appraisal. The top 3 you worry about, those are on you. And the bottom one, don't worry about it. Just let it happen. We'll figure out how to work through it. Credit. So I'm not going to bore you with what a credit score is. If you're in this room, you probably have good credit. Basically, what you need to remember here is that as long as you have about a 680, you're going to get the best rate possible specific to the VA loan. On other, non-VA products, probably about a 725 is where you need to be. And basically, what we would do is when you call me, I pull your certificate eligibility, and I also do a soft pull. Why do I do a soft pull? So my wife's at Columbia Business School. Her classmate is an Army Delta veteran. So he had deployed in September of 2020. He broke an auto lease in September of 2020. Fast forward 4 years, he's buying a house now. Well, his credit score was like a 540. I was like, dude, I know you're an Army guy, but like, what the hell were you doing when you're on active duty? And come to find out that he had an auto lease that the auto dealership never took off his credit report. So for 4 years, he's technically been missing payments. So we were able to call the credit bureau, get that upgraded or updated, and get his credit upgraded, which is huge because at a low credit score, like sub 680, he's going to get a terrible rate. Now he's up at like 740, done. That took about 30 days. So like you want to know about that stuff immediately. You don't want to find out about it 7 days before you're going to close. And about that 7-day mark is when I do a hard pull. And we do it once in the closing process just before you go, to get your actual like money funded. Lots of us have credit cards that give us free credit scores. Do yourself a favor and pull your credit from annualcreditreport.com. This is just a plug for these. This is the government website. You get 3 free credit reports a year. And that way you're not getting like blindsided, a year from now when you're trying to buy a house or whatever, and you find out like, oh gosh, USA never canceled my auto loan. It doesn't give you a score. A score is a lending thing. I can give you a score. Credit report can tell you if you have any delinquencies. Assets. So any cash or cash equivalents, 401ks, IRAs, stocks, TSP, the van sitting at your parents' house, all that stuff is an asset. Any gifts from a non-ownership party, so someone that's not going to have ownership over the property, right? So like your boyfriend or girlfriend cannot give you $10,000 and then say like, oh, I own 1% of your property. That's not a gift. They have to write a letter that says like, I don't take ownership of the property and I'm doing this because Erica just graduated from Darden. I'm really proud of her. And that can come from anyone, friends, uncles, aunts, moms, dads. Any cash or cash equivalent that you're using as an asset has to sit in the account for 60 to 90 days. That's called seasoning. And that's so that like, if you cash in your Bitcoin, basically we know where it came from and we're not just like, oh, where'd you get 100 grand from? And if you do, it's not a huge deal. We just have to show that it's like not fraudulently, it's not like a fraudulent cash. It's like actually legit. And then you can use a loan for closing cost as long as that loan counts towards your debt to income ratio, which we'll talk about in a little bit. So if you want to get a loan from USA on, a property that you already own, or like you want to get a hard money loan from someone, that's fine. It just counts towards your debt to income. That also factors in for student loans, which we'll talk about in a little bit. Income and employment, that's why you came to the school. So traditionally you would need 2 years of work history, but because you presumably were doing something before Darden, now you've come to the MBA program, which is conveniently 2 years long. And then now you're going to leave, hopefully with a full-time job offer. What I'm able to say is, oh, well, this man or woman, did something in the military, came to Darden to get a job. Now they're, been in a job training program for 2 years. If you did an internship over the summer, it's even better. They did an internship over the summer that's commensurate with them getting a job. And now they have a job offer and coming out. As long as that job offer starts within 60 days of your closing, i.e. let's say you close on May 1st. If your job starts on July 1st, great. And honestly, that timeline's a little flexible. I give you numbers in this slide deck. These are like the 80% numbers, right? Like pretty much everyone can get approved at 60 days. If you have a lot of assets, we can get you out even further. The exact verbiage that the VA says is if you have enough cash assets to pay for the mortgage payment until you start your job, then you can close as soon as you have that job offer. So that means if you're staying in Virginia within driving distance of school and you have a lot of assets, you can, as soon as you get your job offer, close on a house. So that's something that's kind of interesting. But keep in mind, like about 60 is normal. If you're going to go do a search fund after school, i.e. you're going to be self-employed, you do need 2 years of tax returns. You could structure your search in a manner that would be like a job offer to you. So you would like structure an LLC, the LLC would give you a job offer and then would go like that. But the business would have to have been in place long enough to be like a legit business. Like you can't just like start an LLC and start paying yourself the next day. Disability, BAH, BAS, any non-taxed income, that gets grossed up 25% towards your effective income. So if you make $1,000 of disability, on paper, to me, you actually make $1,250, which is cool. Any pre-existing rental. So if you bought a house when you're on active duty and you've been renting it out for 2 years, awesome. We get to show the full amount of income on that towards your effective income. We would just need you to have 3 months of PITIA, which is your principal, interest, tax, insurance, and association fees. That's a big one. If you're in like a condo and it's $1,000 a month association fee, just make sure you keep that $1,000 a month as well as your mortgage payment, because that's like one of the hard rules that like we have to follow in order to close your loan. If you don't have more than 2 years of tax returns, it's not a big deal. You get 75% of your gross rent and you add that to your effective income. So that's their way of kind of like judging like, they're probably going to have about a 25% loss in this business, maybe, unless they can show it, prove it to me after 2 years. So that's where I'm going to factor. Property value and appraisal. So as I said, VA loans had like a terrible stigma of inspections and standards and no chipping paint and handrails and like all this crap. That does not exist anymore. In 2020 and 2021, vets were losing houses to people that were paying in all cash or with loan products that didn't care as much as VA loans. And anecdotally, the VA has three missions. It's medical care, training and education, and housing. And they were like really failing at housing. So they completely restructured the VA loan. And now it's, as I said, just an appraisal. And in some states, a termite inspection. But here's something interesting is I live right here in Connecticut, which is a termite inspection state. I did not have a termite inspection on my house. Why? Because the house that I bought, I had an inspector say it was not an official termite inspection, but I had the inspector note that there were no termites, and the house had an active termite plan in place for like 25 years. So they were like, okay, cool. Like that termite inspector, or that termite plan guarantees no termites. And this other inspection that he had says no termites. And that's just because the seller of the house didn't want any like official inspections. And that's the other thing is so like I just kind of alluded to like structuring a deal. So I put an offer in on this house, hyper competitive market, VA loan. I'm competing against all cash offers. Now I wanted an inspection on the house. You should try to do an inspection on your house before you buy it. But the seller was like, oh, well, I have cash offers behind me with no inspections. Can you do no inspection? I was like, yeah, sure. So he accepts my offer. As the offer is coming back to me to sign, I'm ordering an inspection and having it done. And I'm just telling him like, oh, well, it's just for me. It's just for like my own education on the house. Like, I just want to see if there's anything wrong. And so before I countersign the document, I'm verbally getting like a, hey, this house isn't a piece of crap from the guy inspecting the house, and then I sign. So there's ways to do it that like, you know, you're kind of gaming the game. And sure, like I would have looked like a real asshole had I walked away from that deal. But what's worse, that I look bad to a guy that I'm never going to see again, or that I lose $1 million because I didn't buy a good asset. So protect yourself, but do what you need to win the game. Many items can be waived. Appraisal is not. If the appraisal comes in lower than, this is another great thing for the VA. So I already told you about like that the VA called that seller and was like, hey, you should reduce your purchase price. Let's say that doesn't happen and the VA appraises the house at $950 and matches the civilian appraiser that you had. You would just bring cash to close, which is not a big deal at the end of the day. You just bring some cash, make up the delta if you still want to buy the house, and you close on it, which is good. Underwriting. So underwriting is when someone that is not biased to you, right? Like we are going to become friends throughout the process. Like I care about you inherently because I'm also a veteran. I'm an MBA. Like I walked in your shoes. But someone is going to put their license on the line that is just going to see like file number, amount, location that doesn't care. And the one thing that they do care about that I can never talk them through is residual income. And the only time residual income will come into play is if you're like trying to absolutely max out your VA loan. And so I'll say things like 70% back end DTI and 50% front end DTI. DTI is not a hard stop. Residual income is. And what you should remember is basically that like you need whatever this number is, every single person is different. It's based on, you know, your debts, your childcare, your income taxes, like all this stuff factors in this big calculator and it spits out a number. Let's say it's 1,500. If you're at $14.99 and 99 cents, that loan will not get funded. So that's just something that we'll talk about as we move through the process. The other thing I thought was interesting is that they included Delaware in this. So clearly they didn't brush up on their Civil War history as Delaware being in the South. But I thought that was one of the interesting things. DTI calculations. So front end is just your principal and interest. So that's just your mortgage. That's just what you pay a bank. Back end is your life. It's your mortgage, it's your loans, it's your bills, childcare, whatever, school loans, all that stuff. So front end, you want to be about 50%, back end 70%. And these are like max numbers. Really, you should shoot to be below that. When I graduated school, I was like, my wife was in the Navy. We lived on base. We were super frugal. And I was like, I want a big ass house and I want a steam shower and all this stuff. And then 6 months later, I wanted to jump out of a window as an investment banker. And I was like, oh my God, I have I have signed on for too much debt. And we'll talk more about that, but like maybe don't do that. Manual underwriting is a savior. So this is where, let's say you're doing what I did, where you're going to graduate business school and you're going to go be an investment banker, and half of your income is deferred to an end of year bonus. So I have the ability to talk to that underwriter, that person I told you about that was, had no bias towards you. And I can say, well, Erica actually is, yeah, she's making 150,000 base, and she's also going to make another $150,000 in bonus. And by the way, she actually has like a pending disability of $1,700 a month that might be coming in the next 6 months. And so it doesn't actually change your debt to income ratio, but it gives the person that is like signing their license online, saying like, okay, like I do think this person is actually going to be able to cover this debt. Student loans, not a big deal. Tons of us have them. I had them. You take the balance times 5% divided by 12, which is a pretty favorable thing compared to what other debts will be assessed at. And that goes to your debt to income calculation. Any loan or lease less than 10 months is considered insignificant. Unless it can be excluded unless it's significant. So what is a significant loan? If you leased a Ferrari when you were on deployment and it's $4,000 a month, that's significant. Your $79 Peloton, not significant. Spousal debt, this is a huge one. So if you're married and you apply for a loan, sometimes I will tell you to take your spouse off the loan, or to take yourself off the loan and allow your spouse to be on it. Because in a non-community property state, i.e. Virginia, and many others, there's not that many community property states in the country, we can assign debt to one party or another. So you can unencumber yourself. So let's say you had a lot of debt and your spouse had no debt. You could make yourself look like this tremendous borrower that has tons of income and no debt, because we can assign the debt to you. So that's something to kind of play around. But that's separate from the deed and title of the home. The home will be owned by the two of you, but the mortgage is just under one person's name. Childcare always counts towards that residual income. The VA assigns your children some value that it costs, or some price that it costs to have them, and so it has to count towards residual, and it could count towards debt to income. It counts towards debt to income if they're in private school and they have a tuition bill due on the first of every month, or you have a loan to pay for that private school, that counts towards DTI. This is an interesting. What do you think the max distance that you have to drive before I have to say hey, I need to count that towards your DTI, and I also don't know if that's actually where you're living? What do you think? What do you think the max commuting distance is per month in a car behind the wheel? Come on, Bill, you got it.
I guess 50 miles a day. I don't know what that adds up to in a month.
50 miles a day with 1,500 miles. It is Dave, 1,000 miles a month. That's close. It is 4,500 miles a month. If you're driving in a car 54,000 miles a year to and from work, then I have to be I don't actually think that you're living in Dallas, Texas, and your job's in San Francisco. And you're but it actually is, Will, because I'm hybrid and I only have to go once a quarter. And I'd be okay, that's actually pretty cool. So you would just explain that to me, and then we'd write a little letter, and that would be fine. So this is what debt to income looks like on a simple Excel calculator. And so this is front end. This is what you're going to use to figure out what do I want to spend for my mortgage? Because remember, back end is specific to the home. It's very it's your home insurance, it's your taxes. You cannot figure that out until you have a property in mind. Front end, and you can't even figure out the full payment until you have a property in mind. Front end is what's my interest rate range and what do I feel comfortable with spending? So let's say you're making 15,000 a month and you have a little bit of disability, and you say to me, like, I think I want to spend, I don't know, $10,000 a month because I'm a banker and I'm going to have a boatload of deferred income later. Well, okay, cool. Then like that's why you feel comfortable spending 60%. And so you come over here and like interest rates right now are like in this range, like 6.75, 6.5, and you're like, okay, like somewhere between 1.25 and 1.6 million. And then you use that and you go to Zillow and start your home search. Multiple buyer scenarios. So let's say you came to UVA and you met another veteran and you guys want to purchase a home together. That's easy. It's called a vet to vet VA loan. And each of you will be charged 50% entitlement. And now the only stipulation of this is that let's say you had both purchased homes together, or rather both purchased homes before, and now you want to purchase one together, you can't now stack your entitlement. So if one had $150,000 of entitlement remaining and one had $100,000 of entitlement remaining, you couldn't now have 250 and go buy $1 million house. You would get 50% each. So you would get, what was that, 125,000, and then go get to buy a house with that. So a non-married car borrower, so you came to UVA and now you met a civilian significant other, that's fine. It's pretty much the same as above, except you get 12.5% of your guarantee instead of 25%. So you only get 50% of what you had previously. Now, why would you do this? If you needed extra income to qualify for the loan, so you're one of those search fund bubbas and you need some extra income, the only stipulation is that you have to cover 50% or more of your mortgage payment. Otherwise, we will not get you underwritten. So the principal reason for a VA loan is as a primary residence, occupied within 60 days, occupied for a year or more, and should be your primary residence for that whole time. So that's the primary reason, right? Let's say you have a valid change of circumstance. So what is a valid change of circumstance? So I graduated from Wharton in June of 22. By June 2nd of, no, I'm kidding, by by Christmas time, I was so depressed being an investment banker that I was like, I can't do this anymore. And I hadn't seen my kids in like 3 months. And if you're going investment banking, I'm sorry, you'll learn a ton, but it's tough. And I was like, I have to do something else. So I wrote an email literally to the VA and it was like, hey, like I don't want to do this job anymore. My wife's leaving active duty. Like, can we go buy a different house? And they basically instantly replied and were like, yep, that's a valid change of circumstance. You're good to go. I was like, sweet, thank you. What is not a valid change of circumstance? So I'm going to give you a real example. So a guy that I know who became a client of mine, but this is pre being a client of mine. He buys a house for $150,000 in Virginia Beach, Virginia, which the loan limit there is $766,750. So he buys $150,000 house. About a month later, he says, I feel unsafe. That's a valid change of circumstance. I want to go buy another house. So he goes and buys another $150,000 house, conveniently about a block away from the previous one. Then about a month later, he buys another one. A month later, he buys another one. So now he has 4 of these. And then he buys his 5th house using the first time home buyers assistance loan, the FHA loan, which is legal. You can do that. But the underwriter, who had also underwritten all previous 4 properties, finally is like, wait a second, dude, you've used the same change of circumstance every single time. Like, you're full of shit. And so they did a due on sale clause on him, and he literally got a call on the deck of a US ship saying, hey, you owe us $600,000 in cash by the end of this week, or we're going to foreclose on your properties. And so he called us like freaking out. And he's like, how do I do this? And we ended up rolling the other 4 into investment property loans and helping him actually get his house, which he did live in, which is his FHA loan. And then we were like, don't do that anymore. Bad. So that's, you can game the game, but do not cheat the game, because they will slap you really hard. And the US government is really quick, as we all know, very quick to give you their money back and really quick to take yours. Remote work, so I talked about it a little bit previously, but you do just need an employer statement defining what your in-office time versus your work from home schedule is. So whether it's once a week, once a quarter, whatever. And then the other thing that the letter specifically needs to state is, let's say your job is headquartered in San Diego and you're living in Texas. It just needs to say, by you not being co-located with the business, that you receive no change in overall compensation. And then I talked about commuting. You can commute about 4,500 miles per month before we would have to impact your debt to income ratio. And this bottom one, this is really interesting. So this changed on January 1st of this year. A residential property can have a single accessory commercial space or dwelling. What the hell does that mean? So in a place like Richmond, Virginia, Baltimore, Maryland, Annapolis, Maryland, Alexandria, Virginia, Charleston, South Carolina, you have a relatively dense population and a small geographic area. And so you'll get commercial spaces below and residential above. And so you can buy the entire building with a VA loan and then rent out a commercial space. So we did one in Charleston, South Carolina, where it was a Subway on the bottom, triple net leasing for like $45,000 a year. And it was a 3-bedroom townhome above that. So the person that we were working with bought the townhome and the whole building, and then had Subway paying more than half of his rent with a triple net lease, which is an incredible thing. I haven't seen too many of these come across. If it's going to be someone that's going to figure it out, they're probably an MBA. So I'd be proud to say that I saw someone do it. But they're very few and far in between, honestly. Multifamily properties. So you can buy anywhere from a condo, a $100,000 condo, to an $8 million multifam property with the VA loan. As I said, like, there's no real limit. The largest VA loan that we've ever done is about $4.5 million, but that doesn't mean if you're qualified for it and you can make the income work, that you can't get qualified for more. So multifamily property. So the VA allows for up to 4 families in a residential unit. The only requirement is that you must occupy 1 unit as your residence, and then the other 3 you could rent out. You have to prove your likelihood of success as a landlord. Erica, what do you think it means to prove your likelihood of success as a landlord?
That you have renters available or that would want to rent it.
Close. It means that you can't have gone to West Point or Air Force Academy. No, it just means that you have to show that, like, you have the willingness to be a landlord. It's kind of, I put things in quotes, like lawyers say these things, and I'm like, what? How the hell do you prove the likelihood of success? Like, probably if you were a platoon commander in the Army, you probably were likely to succeed as managing someone's condo. But that's just one step that we have to go through. Cash reserves, you need to have 6 months of PITI, of mortgage payments, PITI. And remember, it goes back to the association fees things. If there's an association fee, just make sure you have that. So, in the $4 million example, you would need to have 6 months of $32,000 a month payments. So it starts to add up pretty quick. So just make sure, like, that's something you're thinking about if this is something that you want to do. What you were alluding to, Erica, if you don't have experience managing a rental, i.e. you don't have 2 years, then you will need a property manager in place. At the date of closing, you need a property manager in place. If on the next day you fire that person, I guess you're going to figure out how to be a property manager. Rental income. So before you have 2 years, you get to count 75% of it towards your effective income. So let's say this is Arlington, Virginia, and you find one $1 million townhome in a stack of newly built townhomes. So the other thing about this is that all the units, whether it's 1 to 4, you can only buy 4. More than 4 is a commercial property, but let's say 1 to 4, and they have to transact at the same time. You can't, like, stack them later, like, they have to go at once. So let's say you go look at one and it's a new build in Arlington, Virginia, and you're like, oh man, this is pretty nice. Okay, cool. My payment, these are just rough numbers. My payment would be $8,000 and I'm making, $22,000 a month. Sweet, because I have $250,000 in salary because I'm an MBA graduate. So back end DTI is about 35%. Awesome. Oh, cool. I think I could rent this for $8,000, which my effective income would just be $2,000 less than that. Okay, sweet. Will said 70%, like I'm at 55. Oh, I could get a third one and still be under. Oh, damn, I can't get a fourth because I'd be above the 70% DTI. Actually, you can, because in reality, your actual income is more like in this level, because this is where like the manual underwriting comes back in, where I'm saying like, well, he or she's, yeah, it's showing at 78%, but in reality he's actually at like 35% because it's a one-to-one payment to rent exchange. Where does this exist? It's places like Washington, D.C., San Diego, Pensacola, Florida, ironically, New York City area, Boston, Dallas, Texas, Nashville, places that there's basically a higher willingness to pay from the renter. And, it's a place that you want to own. You can also find these in other places, but they don't exist everywhere in the country. Like, I'm not going to tell you that every multifam deal is a great thing and you should definitely go do it. You have to have the appetite for it, number one. And, I don't know why you guys went to business school, but like, I know exactly why I did. And it's to give my family something amazing in the future. And if you can hand someone a $4 million asset that's income earning, like, holy shit, talk about changing your family's stars forever. It would be incredible. And I do see these come across my desk. Like, I literally looked at one a year ago for 3.3 million in Stamford, Connecticut. On day one, it would have been cash flowing above my mortgage payment, $3,000 a month. And that's because Stamford's 45 minutes direct to New York City. So it's a huge commuter town. It's right next to where I live right now. So this is just a single family versus multifamily DTI calculation. So same thing that I showed you before. This is just on the multifamily side. And this accounts for 75% of your rent roll coming back into your effective rent. So this just shows you like, okay, I think I can get approved for about $1 million over here. Sweet, it's a $3.3 million multi if I can find a place where the rent makes sense. And again, I'll share some of this stuff with you at the end. So this is what I did coming out of business school. I would tell you to not do this unless you want like golden handcuffs and enough anxiety to crush an elephant. So I was like, all right, I'm going to New York City. I want to live in Greenwich, Connecticut. I want a house with a steam shower. So I found a $2.725 million house. I was approved for $2.85 million. And I was like, perfect. It's under that approval. Let's go. And so I bought it. Right. And then I was like, oh man, I don't want to do this anymore. But luckily that house had gone up. It made about 10% annualized return over the past 2 years as of when I made this PowerPoint today. My principal, interest, tax, insurance, and association fee is $15,000 a month, and I rent it for $17,000 a month. So I'm instantly at a 6.38% cap rate, which to put that in market terms, normal market's about 5.5% for rental properties. So my 4-year ROI from that is 50% over sunk cost. So that includes like the cost of me living there. And if Peyton and I sell it when she graduates from business school, I'll walk away with $450,000 in profit, having lived in the house for about a year. Now, I know what you're saying. You're like, well, dude, that's because you didn't live in it, you turned it into a rental property. Even if I had been paying this mortgage, I would still walk away with like $150,000 in profit, and I would have gotten to live in a $2.7 million house instead of banging my head against some New York City apartment. So this is an example that worked out. If you came to me and you said, I want to buy a $2.7 million house, I'm probably going to reach through the telephone and choke you because, I wouldn't want my worst enemy to have to make the decisions that I was making at the time, but it did work out. This is what you can take away from this is that like, there are ways to make this work in your benefit. some other benefits of having a house. So like everyone just did their taxes, right? I saved actual cash value of like money back to Uncle Sam, $15,000 in taxes because I owned a home and I got to depreciate the asset. So it's an incredible thing instead of like throwing that money literally into the wind of a renter and giving it to some landlord that doesn't care about you. And I'm happy to talk either on this call or another about like what it takes to figure out like, is it worth it to me to rent versus buy? Like when I look at that stuff, I let the numbers, like people are naturally irrational. Just like let the numbers drive you. Like I assign like a no shit value of what it means to me to own my home and not have someone tell me like, oh, you have to get out today. I'll tell you a quick story. My wife was active duty. I was going to Wharton at the time. We were stationed in Washington, D.C., and I was commuting back and forth every single day. And I had a 6-week-old at the time. And our landlord literally showed up on our door. This is in like the height of the 2020 market or 2021 market. And he's like, hey, the house is worth a lot of money. And so we're going to sell it. You got to get out. And I was like, wait a second, dude. I have a 2-year lease and I also have a 6-week-old and it's the middle of a global pandemic. And I can't tell you the amount of stress that caused us. And I swore to myself that I would never allow someone else to have that much control over my family anymore. And so I literally take a dollar value when I was like looking at like, should I rent in New York City or buy somewhere else? I like literally put a dollar value of like what that stress meant to me. And actually it was pretty easy because I ended up suing him. And so I knew exactly what the court defined the value of that because he tried to breach contract and he was also an illegal landlord. It's a long story. Take away from that, don't be an asshole and try to kick out a young family when they're renting from you. But also like, don't be irrational, let numbers drive your decision. So we'll do a case study. So let me go back to the front here. So if you can just go to that web page, we'll do a quick case study. So in there, you're going to put in like where you're going, what you think you're going to make. There's some like your name and email at the top. I'm not going to spam you with crap. I'm going to send you the Excel sheet that we worked from and the PowerPoint that I did today. And also I'll send you the recording of this video so you can send out whoever you want or reference it for later. And obviously you can call me if you need anything. But if you go ahead and do this survey, then I'll take you through kind of what I look for when I'm deciding if I want to buy a property. And again, I'm not the real estate guru, but I've done it enough that I feel comfortable, telling you what I feel makes a good property. And I've also seen it done about 500 times personally. So, I feel like I've gotten a good hand on it. I personally look for 10 out of 10 school districts and Whole Foods. And you're probably like, why do you look for Whole Foods? Do you really like, overpriced guacamole? And 10 out of 10 school district is because I am very downtrodden. I am bearish in mindset. And when it comes to financial markets, and so I constantly think that we're in a bubble. And so if we're in a bubble, what do I think are the markets that are going to hold value? And I think it's the ones where people do not have to pay a bunch of money to send their kids to private school, i.e. 10 out of 10 public schools. And then the other reason I look at Whole Foods is that I own rental properties. And if you're willing to pay $8 for an avocado, you're not going to mind that I raise your rent by this, CPI every year. And that is that's pretty much held true through the investment properties that I own. But I have like friends that draw concentric circles around high-end retail, like Bonobos, Lululemon, Core Power Yoga, Chopped. And then, and similar thing, like if you're going to pay $20 for a salad, like you're probably going to be good tenants. And he literally draws circles and he finds the neighborhood where those intersect. And he's like, sweet, I'm buying on that block. And it's worked out really well for him. So we've got a whopping 1 response so far. 2 responses. All right, there we go. Thank you. Bill, you just earned yourself another $100 off of your loan. Guys, Bill is racking up the dollars today. That's $200 now to Bill. And Cooper, I'll give you $100 because you were second in the list. And for those that are like, what the hell is this guy talking about? Bill and Robert Milton were the first two with their cameras on for today, so I gave them both $100 off of their future loan as cash in your pocket at closing, so that I'm not just talking to myself with cameras on. There we are. Look at this. I love when people are financially motivated. These things are rolling in now. Thank you, David, Holly, Alex. I appreciate it. Erica, I see you. I'll make a deal. Anyone who gets in their survey in the next 3 minutes gets $100 off their loan. Like cash, actual cash. And in the meantime, I'll go over some Q&A. How much, so first question, how much can I afford, should I spend? Factors to look at when considering a multifamily. That's a really great question. I'm going to run through that exactly in the case study and show you kind of how to figure that out. I have used a VA loan in 2020 on a duplex for $400,000. Nice job. Wondering what I have left to use. I will show you that calculation as well. Are home loans realistic, beneficial for single people? I think so, yes. Here's why. So I told you that I looked at that multifamily property that was $3.3 million. Like, I can't do that realistically, guys. I have a wife who goes to Columbia Business School. Like, she's busy all the time. I have 2 kids. Like, I'm busy. I can't really manage, I can't manage a multifamily and live in it. But if I was a single person and didn't have 2 crazy bastards running around my house breaking stuff all the time, I could probably be a really good landlord. Those are the things that I would look at as like beneficial if I was a single person. That's just something to think about. So, okay, we have 9 responses. Thank you very much to everyone who's put it in. And I'm going to take you through how to do this now. So first step, can you guys see this Excel sheet? You can say, okay, sweet. So let's see how this shook out. So thank you to everyone who responded. Wow, this is awesome. So everyone in the call right now, at least everyone who responded, is a 2025 year group. That's awesome. I wish that as a first year, someone told me that I didn't have to go to New York and like have 2 years of income to then go buy my house in San Diego. Because I was stationed in San Diego for 4 years with my wife. It's the greatest place on earth. No one can change my mind. I wanted to go back there, but I was like, oh, I need this big salary so I can buy my house in La Jolla. Well, come to find out, I actually didn't. I could have gone and worked for Callaway Golf and not been an investment banker in New York. So hopefully something that you take away from this is choose your life, not let your job choose your life. Choose where you want to live and then figure out your job from there. So glad to see you in there. Okay, so looks like we have 2 for Atlanta. So this is what city are you most interested in? We have 2 for Atlanta, Boston, Charlottesville, Virginia, Chicago, 2 for Chicago. Looks like Atlanta, 2 for Atlanta is the most highly populated one. So I'm just gonna go down here. We're gonna go ATL. And it looks like most of us are looking at single family. Looks like most of us are going to make between $150,000 and $175,000. So we're going to call it 162.5. Looks like most of us have between $3,500 and $4,000 of BH or disability. So we're going to call that 3,750. Most of us are not, actually it's a tie between not married or spouse between 50 and 75,000. So we'll give it to the married folk just so you can see how that works. So married 62.5, and most of us, our spouse is not a veteran. And then the budget looks like the average is between 750 and 1 million. So we'll go 750 to 1 mil. All right, we got some more questions that I'll cover in the end. All right, so the first question was, how much can I afford? How much should I spend? So this is what you do. You come in here and you're like, all right, I'm gonna make $162,500. My spouse is gonna make $62,500, and I make $3,750 in disability, which, remember, you get this little plus up. Remember, you get 25% plus up. So sweet, you're making a pretty gangster salary. So you come down here. I didn't ask this, I probably should have, but do you want to see how student loans work? Would that be worthwhile? Yeah, okay, cool. Let's say you have $100,000 in student loans, and you're going to Atlanta, so you probably have a car, and you're a millennial, so you definitely have a Peloton, and you come over here. So this gives you your net effective income. So then you come over here and you're like, all right, this is a personal choice. Where on this, range do I want to be? What do I feel comfortable with spending every day? And I can tell you that most people, excuse me, most people fall between 50 and 30%. The national average for housing is 40%. And so then you come here and you're like, all right, like, we'll set interest rates are about 6.75. So like, let's look at this range here. I can spend somewhere between 1 million and 1.9 million on my house. So our original range that we thought was 750,000, but like, this is saying we could spend a little more. Now, this is an important thing to note. Before you saw this, when I'm saying we as a class developed that we wanted to spend somewhere between 750 and 1 million. Well, I just showed you that you can really realistically get approved probably like way over in this number, which is a shit ton of money. If you're making $22,000 and spending 15 of it on mortgage, that's pretty tight. You're gonna like have heart palpitations every time the month starts. So like, set a number and don't let yourself be swayed. Because let's say you pick the $1 million number. This is what's going to happen. You're going to go down to Atlanta and you're going to look at a house, and it is going to transact so fast. You're going to call me. I'm going to send you a pre-qualification. And before that pre-qual even gets seen by the seller, some person is going to buy it in cash, and you're going to be like, oh my God, they had $1 million in cash. Like, I've never even seen $1 million in cash. And then you're going to call me and be like, dude, I want to spend more money. And I'm going to slap you for the phone, because I'm going to be like, no. Because what happens is you're going to be like, well, you told me I could spend more. Because yes, you can. But guess what, guys? It's still going to transact at 1.35 really fast. And then at 1.675, it's going to go really fast. And at 2 million, it's going to go really fast. And what's going to happen is you're going to get budget creep, and you're going to keep going up and up and up in value. And then eventually you're going to be like, well, damn, I can't ever live in a $1 million house, because I've been looking at these $1.8 million houses, and like, they have steam rooms, and I really want a steam room because, I was in the Army for 5 years and I'm tired of hating my life. And if that's what you want to do, you are a free thinking adult. I will support you as your lender, but just like, let the numbers drive you. Pick a number on this scale and let it go. So we originally picked 750 to 1 million. What do we want our range to be for the search? Do we want to look at like what the national average is, like 1 to 1.5 in Atlanta, and see where that goes? Bill's got a head nod. All right, Bill gets another $100. Bill, you are quickly eroding all profitability in your loan. All right, so we're going Atlanta, and it was 1 million to 1.5, and we want a house. And let's look. So like, I know a little bit about Atlanta because I've been there. So like, if I was going to live in Atlanta, so the other reason I really like Zillow is you can come here. Remember I told you 10 out of 10 school districts. So I would go here and like realistically, I say 10 out of 10, but like an 8 out of 10 school district, still pretty dope. And I look and I'm like, okay, cool. There's an 8 out of 10 school. There's an 8 out of 10 school. Like some other things that you can add on here. Like you can look at grocery stores. Remember I told you I like Whole Foods. So you're like, okay, there's a grocery store and East Atlanta Farmers Market. Probably got some pretty tasty chicken salad. And it's like, I really like Parks. Like that's a pretty house. That looks nice. You guys tell me which one do you want to analyze? You see any that you like? This one? Bill, what do you think? You choose. Who chose? Someone that chose Atlanta has to pick the house. If you chose Atlanta, I will give you $100 off your loan to come off microphone and tell me where you want to Atlanta.
Bill Inception you. He's going to Atlanta.
The 1.39 one is pretty.
Which one?
I think Haley's the other Atlanta person.
Yeah, me and Bill are the Atlanta people. The 1.39 one that was just on the right. All the greenery in the front. Yeah, the second here? On the right.
Oh yeah, this looks great. Let's see where this is. Looks like a great house. This is very pretty. There's one picture, of course. Killing my example. Okay. So you'd want to like, let's just pick one with a lot of pictures because I'm a Marine. I like pictures. So you just come through and you look and you're like, man, that's a nice house. Like that's a place I want to go tour. So we're going to go back here just because someone that was going to Atlanta picked it. So you come in here and you just read this. Just make sure it doesn't have anything that's like crazy in it. Lots of times people just like skim over this. Sometimes there's stuff in here, especially with the change to the National Association of Realtors lawsuit, which you may or may not understand what I'm talking about. You could be on the hook for paying a fee that you're totally unaware of unless you read through this stuff. The other place you want to look is you want to come down here, show more, and come down here to this section, HOA and financial. So this is normal, this buyer's agency fee. This is probably going to be paid for by the seller. Sometimes in this section, it would say something like community assessment or construction fee or some crap like that. And that is a direct, basically tax that you pay when you transact on that home. So you just want to be aware of what you're getting into before you actually do it. And then the other thing is you want to look and see if there's an HOA. It also says it up here. So this one has no HOA. So this is a 1.4 house. Cool. And then the other thing that's nice about Zillow is it tells you your property taxes. So $15,120 per year. And all right, nice. And it also tells you some school information. 8 out of 10 school, probably going to be pretty good. According to my metric, you're going to have your own metric that is hopefully way more correct than mine is. And if it is, please, God, share it with me so we can all keep this thing going. So let's see what this looks like. So we picked this one. So then we come in here and it's Atlanta. It's a pretty hot market. So it's probably going to transact at asking price. Interest rates today were 6.75%. And actually, I'll just take this time to say, anyone who's willing to give you a quote without like looking into your file and like knowing a little bit more than the average bear is lying to you. Like I could tell you right now, legally, I could tell you like, oh, I'll give you a 5.25% rate. You're gonna be like, holy shit, Will's the man. He's gonna give me a 5.25% rate. And then it comes time to actually transacting in your house. And I'm gonna hand you a loan estimate that says 5.25%. You're like, man, he's sticking to his guns. He's actually gonna give me 5.25%. And then this is from a shiesty, like, used car salesman lender, which I'm not. And then 7 days out from closing, I'm going to be like, hey, Bill, I'm sorry. I did give you that $300 that you earned in my class, but hey, dude, market rate is actually 7.5%. And I have you paying 5 points in fees. And you're going to be like, dude, and I'll be like, I'm really sorry, dude, I tried. But like, hey, if you could just sign this because you're closing in 7 days and now it's too close for you to go find any other lender. So you're not necessarily shopping the rate when you're like talking to lenders. What you're actually figuring out is this man or woman going to screw me and take their profits over mine? And in the end, guys, like that's why a retail lender, like, don't go to a retail lender. Don't go to someone who's going to make money on your loan. Go to someone who is a broker. Like, you don't pay me anything as a broker. Someone else pays me, and you pay a processing fee, which is you pay everyone. So don't, like, the rate market is like the stock market. It's not some big secret. Today it was 675. Like tomorrow it might be 6875, whatever. But don't be super obsessed with that. The other thing is that I'm kind of getting off tangent here, but the cost to refi a VA loan is really low. So I can't speak for all lenders, but for me, there is no cost to refi because I'm just reallocating your block of money to a new coupon. And then you pay a state title fee, which is the state recording basically who owns your loan on the title of the home, which in Texas or like California, I'm trying to think what other ones I just did, North Carolina, Florida, it's like $2,000. And basically, if you have more than 200 days on the loan and 0.5% less in interest rate, so market rate today is, call it 6.75. If in 200 days it's 6.25, well, then you should refinance, because if the difference is $500 and it costs you, even if it costs you $3,000 to do it, it's going to play out in the end. So yearly taxes were $15,120 on this house. Yearly insurance, you would have to get a quote. So we're building towards back end DTI. That was an older house, like, let's see, when was this built? 1918. It's probably going to be like $4,500. Atlanta doesn't really have any like natural disasters, so that's gonna be nice, and no HOA. So your total payment is going to be $10,715.37, 48% back end DTI. Like I said, the limit is about 70%, so you're getting approved all day long. The other thing about rate is I'm going to say things to you like, hey, do you want to float or lock your rate? And so you're going to be like, I think that interest rates are falling. I want to float it. And I would be like, okay, cool. Understand the risk of floating a rate. So let's say today you're going to buy and I tell you, hey, it's 6.75%. And like, that's a pretty good rate. The 10-year treasury bill is actually trading up today. So like, we might want to lock. And you're like, yeah, dude, I think it's going to fall. So I want to hold out. Well, like if you do, and you hold out, like interest rates do come down. And let's say it was 6.75. So you've saved yourself $50, $60. What is terrifying about the rate market and what keeps me up at night is that what happens is rates take forever to fall down, and then they jump back up like crazy. So let's say the next morning we wake up and it's 7%. Shit, you just cost yourself $250 a month because you tried to tick the bottom of the rate market. Like, don't try to tick the top of the stock market or the bottom when you're buying. Don't do the same thing with the rate market. Buy the house, shop the rate. Like, you're dating the rate and you're buying the house. So in a year from now, if the rates are 6.5, 6.25, sweet, refinance. It costs you $2,000. Not even in reality, it goes towards your loan, and you save yourself a couple $100. But what you don't want to happen is, like, let's say that you had a reason that you wanted to spend like real big baller dollars and get a big boy house, right? And so I'm just making up numbers here, but so you're like right at that 70% on this house, and then interest rates go exactly like I said, which is they jump up, and then you're like, oh no, I'm now not qualified. I can't get that house. And then what you're ended up doing is bringing cash to close to either buy down your rate amount, so you're bringing like $100,000 to buy down your rate, or buy down your principal or something to get below that 70% mark. It's usually not worth it. That's a long way of saying, like, don't be obsessed with that. Okay, so some other questions that we had. where I used my VA loan on a duplex for $400,000. So remember, entitlement is basically 25% of what you previously used. So you bought a $400,000 duplex, you used $100,000 entitlement. This is something that I would pull from your certificate of eligibility with the VA. Like officially, it might be more like 97,000, but let's just say it's 100,000 for easy math. And let's say you're going to buy in Pensacola, Florida, another great spot. So your county loan limit in Pensacola, Florida is $766,550, and you want to buy a $625,000 house there. So you would need to bring $64,000 down payment. The other things that this show is like, let's say you're not even at this point where you're like picking out a house, but you know up here that you've spent the $100,000 in entitlement. You can start looking and saying like, okay, in Pensacola, I can get a $366,000 house with no down payment. Or in Washington, D.C., I can get a $750,000 house with no down payment. Like, I have 2 job offers. I'm probably going to take the one in DC. Okay, cool. I can get a $750,000 house. And so you can play around with stuff like that. Another thing in this calculator is this multifamily buying scenario. So let's go back to the search and let's look at what this looks like. So we come here and let's say we want to find a serious multifam. So we know that individually we were going to look at, $1.1, $1.2 million houses. And now we want to look at like something that's going to be income earning. This is an awesome example. These are 4 units that could transact at one time for $3.4 million notionally. So these are 2 duplexes. So you could have four single townhomes for $3.4 million. Now, like, hopefully if you're buying all 4 of them, you're probably going to get some discount from the builder, maybe, but like, let's run the math on it and see if it works. So the Zestimate is $4,250. I'm going to assume that that's per duplex. So let's go in here and see how this works. So you're going to buy the first one. So let's see, it was 1.7. So 1.7 divided by 2, 850,000. And it rented for, I think it was 4,250. Oh, sorry, we got to actually figure out your payment first. So 850,000 at 675, taxes 5119 divided by 2. Insurance is probably like $2,200 a year. So your payment's $5,909. So you come over here and your $5,900 payment, and this is yours. This is the one that you live in. And then you're like, okay, my Zestimate on rent is $4,250. Cool. I can definitely get the next one if I want it. I can definitely get the third one if I want it. And more than likely, I can get the fourth. So you're like, sweet, I just bought a 4-plex. And like, yes, this example is one that I just like pulled out of a hat where the rent is not equal to the payment. But like, let's say that this changed a little bit and actually you find out that the market rate is $5,000. So like, sure, from a pity to rent, you're losing money. But when you actually look at what you're losing, you're only losing stuff greater than interest, taxes, and insurance. So if your interest, taxes, and insurance are less than $5,000, you are making money because your principal is the money that you're putting into equity, and it is accruing at the same value that that home is accruing in value year over year. So in my example in Greenwich, my $15,000 a month payment, like 5,000 of it is interest and 10,000 of it is principal. Well, or actually reverse those numbers, sorry. 5,000 of it is principal, $10,000 of interest. So my rent is $17,000. So in effect, I'm making $7,000 on that house every month, but I'm placing it kind of all into like a high yield interest savings account, which in my example has accrued at 10% year over year. This house may accrue differently, but like that's something that you're going to figure out and develop on your own as someone that's like looking into doing this property. So forever ask the multifamily question. If that did not answer it, please let me know. And again, I will send out these Excel sheets. So here's some other questions. Can I use, and also in this, I'll go back to the questions in a second. Also in this Excel, there's like a residual income calculator, which is the most dry subject in the world. So I'm not gonna bore you with that. There's also some examples in here if you get lost and need to figure out what you're doing, but I'll send this out and you can work through it. So let's go. And then also in this slide deck, when you're working through, there's like a disability rating chart. So if you're trying to figure out if you're still working on this and you're like, well, what if I get 40% versus 90%? Remember, you plus these numbers up 25%, which the Excel sheet does for you. And you can also look like, okay, I am single right now, but I think I'm going to have a child. So, how much is that worth? Property tax, these are like general property tax rates. If you're deciding between living in Virginia versus Texas, you can play around with those numbers. And then this is like general case study resources. If you're going to New York City, use Street Easy because it allows you to filter between co-ops and condos. Nationwide, you cannot buy a co-op with the VA loan. And that's because co-ops have a first lien position on the property. They get to decide when you buy, sell, rent, like paint, anything like that. Even if you're buying all cash, I would tell you do not buy a co-op. They have too much ownership over the property. And remember the DTI limits. These are basically like guidelines to follow. And then, if you have any questions, you can definitely reach out to me. That's my cell phone number. Text me, call me. I'm happy to run through this stuff with you. But let's answer the rest of these questions. All right, cool. So can I use the VA loan and FHA loan at the same time? I know my partner wants to live in a condo downtown, but I would love to just have a 4-unit and live in it with the VA loan. Are you and your partner married? And are you both veterans?
Yeah, this was me. So we are going to be married, but we're not both veterans.
Got it.
So
okay.
We'll be married later this year. Yeah.
Okay. So both loans have the same residency requirements, which is 1 year. But there's nothing saying that you can't buy. And the reason I ask if you're both vets is if you both had VA loans. There's nothing saying that you can't buy with one now and then 12 months and a day from now buy another. So that's probably what I would tell you to do. I would, in your specific example, I would probably tell you to do the, I'd probably do the VA loan first and then the FHA loan, just because the VA tends to be a little more strict on, or rather the VA underwriting guidelines. Remember, the VA is not necessarily lending you money here. The VA underwriting guidelines are a little more strict than the FHA guidelines. FHA has a slightly lower debt to income ratio than the VA does, but that's something we can work out. If you have any questions, please don't hesitate to call me. So another question says, owning one house, rent or sell it. So I assume that means you currently own a house and you're deciding between renting or selling it. The calculation there is what I alluded to earlier, which is if your rent payment, the payment that you receive in rent is greater than your interest, taxes, and insurance, then that is where the decision comes in of like, okay, do I believe that this house will continue to appreciate at X value per year? And is that worth it to me to deal with the ass pain of having people live in a house that I own? because I'm not going to lie to you. Like I've had a lot of rental properties in my time, both active duty and now. And like, it's a pain. I'm going over to that big rental tonight to fix a sump pump. So like me and my plumber get to dig out this like big nasty pump in the basement. It's going to be great. But like, that's worth it to me because it's going to be my kid's retirement. If your payment is greater than your mortgage payment, rather your interest, the rent that you receive is greater than your mortgage payment, like there's very few cases where I would tell you like, hey, you should probably sell it. Along that same line is refinancing that. Like lots of us, or not lots, some of us may have houses that we bought in the GPA rate time zone. So like when rates were below 4%, or in my case, when they were, GPA about 2%. But you don't want to refi that, right? You're like, no, like that's such a great rate. But what you need to look at is where you're going next and what it's going to cost you if that's on a VA loan, what it's going to cost you in cash down. Because remember, if you have an outstanding VA loan, then you have a county loan limit. So if you're trying to buy in Atlanta and your county loan limit is $766,000 and you want to buy a $1.3 million house, so just to like show you what this looks like, let's say it's this example, right? So 766, and you want to buy a $1.4 million house, that $1.4 million house that we looked at, it's going to cost you $260,000 in cash to close on the loan. I just realized I'm not screen sharing with you guys. It's going to cost you $260,000 in cash to close on this. Whereas let's say that you didn't have this outstanding VA entitlement, it's not going to cost you anything because remember, it only applies if you have a county loan limit. So that's something else along that line. How can I leverage the current VA loan I have to refi when rates go down? You don't even have to leverage the current refi or the current loan to refi. Basically, if you've had more than 200 days elapse, then you can refinance. 200 days and 0.5% of interest rate reduction. It's called an interest rate reduction loan. And also my refis are free even if I didn't write the original loan. Again, because I'm not doing any extra work. If you wanted to do a cashback refi, that's a different thing that does require some amount of work because we're doing an appraisal, we're underwriting the property, all this stuff. If we're basically just like reallocating the same block of cash to a new loan, there's really no work. I don't charge for that. I can't speak for all lenders, but that's what we do. But you would look to hope basically that your cost of refining, which is your state title fee, is saved in about a year. And that works out to roughly 0.5%. So last question, do I buy a condo in the city or a multifamily in the city, but further away? Can I make money from the condo? You can make money from the condo. You would have to move out of it, right? So like the benefit of doing a multifamily is that on day one, you start to earn income. Now, it might not be in the place that you really want to live. So like if we go back to the example that we were doing here, I don't know anything about this neighborhood. It does not meet my elementary school criteria, but like this might be an awesome investment. So like that's where you need to come in and like finding a really good realtor in the area that can help you be like, yeah, this is like definitely a spot that you want to live or definitely a spot that you don't. And if they're not willing to tell you that, then I would say go find a different realtor. Like they should be able to tell you like, oh yeah, this is a nice spot. This is where you want to live or like where you don't want to live. But basically you just need to decide, do I want to make the money now when I'm living in it, or do I want to make it when I leave? And what does it cost me month to month? Like not in actual dollars, but like in time to manage that property. So that's what you want to think about. All right, cool. Looks like that is all the questions. Is there anything else that I can answer for you guys? Nothing? All right. Well, if you need anything, that's my cell phone and my email address. You can also find me on Instagram at Home Loan Dude. There's one post on there. It's not the most prolific content in the world. But if you have any questions, don't hesitate to reach out. I hope this is helpful. Erica, it's great to see you. Please tell James I said hey, and I'll see you guys in October. Bill, I'll be reaching out to you for your $300 in what amounts to gift certificate money, and everyone else who did the survey. I really appreciate it. I'll send you all these materials. If you have any questions, like I said, let me know. If you know of people that couldn't make it to this, please send them my way. I'm happy to do this again. I'll also send you the recording, and it also goes for vets outside of the Darden network. As you can tell, I love the veteran community. I like this stuff a lot, and I'm happy to be your champion, cheering from the sidelines until you need me. So thanks so much, guys. It's been fun, and I hope to see you all again soon. Thanks, Dave. Thanks for setting this up. I really appreciate it, man.
Thanks, Will.
Anytime. And if anyone has any questions they don't want answered in front of the group, I'll hang out for a couple minutes and can answer this for you.